Federal government has released its much anticipated fall economic statement. Now it comes amid some political turmoil in Ottawa. Finance Minister Chrystia Freeland announced her resignation. Joining us now for more on that update is TD Deputy Chief Economist Derek Burlton. Derek, great to see you as always, particularly in times like these.
Thank you, Greg. Great to be here.
Let's jump right into the update. What's your big takeaway? Is there anything in there that changes your view of Canada's fiscal position?
Not really. I mean, we knew the deficit in the last fiscal year was going to get sharply upgraded, and it did, up to $62 billion. That's about 2% of GDP. So, I guess the good news is, look south of the border, it's about 6.5%, 7%. But it is higher, and and a lot of that is just on the back of booking some one-time measures related to Indigenous, some of the liabilities, children, Aboriginal side, and some of the CEBA money. But going forward, very little to change my take. They have the deficit falling. The amount of new money that's being spent is not, it's within the ballpark of what many would have expected, and it's about $20 billion over 5 years. So not really that big a mini budget, more of, just some additional money, HST and the like. So all that said, it doesn't really change my view. I think some of the skew towards the investment, spurring more investment, was good news. I hope we see more of that in coming months and budgets. And I'm looking at market reaction to my view. It's really not much. I mean, yields didn't go up despite all the uncertainty with the government. Canadian dollar is pretty flat. So on that front, the markets are certainly taking today's news in stride.
I wanted to ask you about that new spending. You said it's not a huge amount of money, a little over $20 billion over 5 years. Is there anything in that new spending that is addressing, to your mind, the economic challenges that this country is facing?
It is a little bit. I mean, there's a lot of work to do. That's the thing. When I look at, we know tax rates are quite high in Canada. We've got a tax competitive issue, particularly vis-a-vis the U.S. This extension of the capital cost allowance, the investment expensing, the quicker, that's very good news, something we had been pushing for. I think my concern I had was, it was under Morneau, they introduced this accelerated depreciation for business, and that was going to be phased out over time. And if the government allows it to phase out, you would have had a big jump up in the effective tax rate on investment, something this country just does not need. So we had been pushing. It's not an inexpensive measure. It's about $17 billion over 5 years, beginning next year. But it was needed, because that's the last thing, as I mentioned, we need is a big jump up. So I was glad to see that. And I think that'll help a little bit. But the uncertainties around the U.S. and tariffs, certainly, this is not a cure-all for that by any stretch.
Let's jump into that uncertainty. Obviously, as we say goodbye to 2024 and the next several weeks and get into 2025, we are facing the threats of tariffs from a Trump administration. Let's talk about how real and possibly damaging that could be for the Canadian economy.
Well, it is real. I mean, it's hard to be in Trump's head. I know you hear two different views that, he can impose 25% tariffs on Canada and Mexico because it would hurt his own economy dramatically, the stock market. It would lead to a strengthening in the U.S. dollar, things that Trump just doesn't seem to want or desire. At the same time, you hear that he's got to follow through with them, because if he doesn't, it's going to be a blow to his credibility in terms of using this as a tool to gain advantage on other countries. So we don't know, but I would, clearly it's a strong possibility, even if we haven't built it into our forecast, and worrisome. And, some of the measures today, I think, will help cushion the blow from that. I mentioned the investment incentive will certainly help, but the impact of a 25% tariff would be so severe in the short run, creating enormous adjustments that, the measures certainly would only partially cushion that, and not much at all. Some of the stimulus on consumers will help a little bit, but it's not big. The HST, a 2-month holiday, is not dramatic. It'll add a little bit to spending next year. But so it is a worry. And, the good news is some of the border spending the government's going to do is going to hopefully help get out in front. That's something that Trump had wanted, about $1 billion investment in border security, drones, and the like. Hopefully that will be enough, but we just don't know for sure at this stage of the game.
We start putting all that together on the fiscal side, and with this update that we've been given and some of the promises, some of the challenges we're facing, a little glimpse into monetary policy for next year. What's the take on where we might see the Bank of Canada move after the pretty aggressive rate cuts we've been given this year?
Well, Macklem stated very clearly, don't expect they're going to keep aggressively lowering interest rates. So, we had a view of sort of 4 quarter-point cuts in 2025, taking the rate down to 2.25 from the current level. And that won't change with today's update. I think this increases the odds the Bank of Canada is going to take a pause at some point in the first quarter, probably the March meeting, cut it in January, take a pause in March. But that's going to be the pattern next year. It's going to be cut, pause, and much less in the way of downward rates than we experienced in 2024.
Derek, always great to get your insights. Thanks so much for joining us today.
My pleasure.